Hello guys, this is the trading journal from Vertical Spread for Friday the 4th of December. My name is David and I'm also known as the Spread Doctor. This week has been a bullish week in the markets, and it was also a bullish end to the week. And it ended bullish in spite of a disappointing employment number. So all the equity indices closed higher, and the small cap index, the Russell 2000, was the outperformer on the day. It was up by over 2%. It is also worth noting that the market rally is now beginning to broaden out. So about a couple of months ago to 3 months ago, every time the market rallied, it was being led and it rallied largely on the back of the FANG heavyweights. So Facebook, Apple, Amazon, Netflix, Microsoft, Google. Those were the handful of stocks that were pushing the market higher. Well, now we have a broader participation. We're seeing the semiconductors leading. We're seeing the banks leading, brokerages, energy, and the small cap. All these sectors are now participating, and some of them are playing catch up to the big moves we saw in the tech sector. And if you're bullish at the moment and you want the uptrend to continue, the one thing you would like to see is a broader participation rather than seeing a market going up on a narrow participation of about five stocks or so. And we saw that not just today, but we've been seeing it over a number of trading sessions, and this will give the bulls a bit more confidence. And if I wanted to make a bullish case for why the equity market rally still has some gas or some legs in it, here is how I would build a case. So I would start making a bullish case by pointing out the fact that the rally is broadening out and there is more participation, which means there's a high likelihood that the rally would continue because it's not just based on 5 stocks. It's now broader. And you can see here energy was up about 5%, financials was up, health sector was up, industrials was up, materials was up 2%, real estate was up, and even the tech sector that was up 1%. It wasn't up because Facebook and Apple and Amazon were up, because they were down. The tech sector is up because of the semiconductors and a few other components within the tech sector. So that is how I would start building a bullish case for why the market can continue to go up, because the participation is now a lot larger and broader than it was earlier. Another thing I'll look at to build a bullish case would be the put call ratio, the overall put call ratio of the market. So the general wisdom is that the put call ratio below 0.75 signals a high level of bullish sentiment in the market. And if we look at the current PC ratio, the current put call ratio, it is at 0.49, which is below the 0.75 level. And there's a lot of noise in this chart, so I overlaid it with a moving average, the red line, to smoothen it out a bit, and you can clearly see that this is trending down, if you like, from this high here to here. You can see it's clearly going down, and the put call ratio basically shows that people are buying more calls than they're buying puts. So around here, this would have been April, March, when the COVID-19 broke out. I think the PC ratio here was about 1.7. People were buying a lot of puts, and now it's down around here, 0.49. People are buying a lot of calls. And that just suggests that, I mean, when people are buying calls, they're generally bullish. They're not buying calls because they expect the market to go down. So that is another factor I would use to make a case for the market having more legs to keep on going up. Another thing I would look at to make a bullish case would be the dollar index or the Dixie. So historically, a weak dollar tends to be good for stocks, particularly small cap stocks. So the small cap stocks whose benchmark is the Russell 2000 tend to do particularly well relative to large caps when the dollar is weak. And this is because most of the small cap stocks tend to be domestic focused, and they have a significant revenue stream in US dollars domestically. Most of the large cap stocks, the conglomerates, the Facebooks, if you like, GE, they tend to have revenue streams globally. And when the dollar is weak and they convert the revenue, say in euro or yen or any other currency, it comes in as lower dollar amounts than when the dollar is strong. And that's why the small caps tend to do better. So here's a chart of the dollar index, and I have overlaid a chart of the S&P 500 for comparison. And you can see the correlation between a low dollar and equity markets going higher. Here, this was 2018. You can see S&P is quite high. So the S&P is green, the dollar is blue. And click here, you can see the dollar trending lower. Here as well, you can see here, and here you can see the market came down and the dollar went up, and at the moment the dollar is down here and the market is going up. So that's another thing the bulls can hold on to, that the dollar is not going to be in the way of this rally because the dollar is quite low. And actually today the Dixie hit a new 52-week low. So that bodes well for anyone who is bullish on equities and is trying to make a case for why equities have got to continue to go higher. Another thing I would point to in favor of the bulls is interest rates. So we have got record low interest rates at the moment, and the Fed has hinted that they do not intend to raise rates anytime soon. When interest rates are low, the equity markets tend to do well, and vice versa. And here is a chart of the 10-year US Treasury benchmark, and I have overlaid the chart with the S&P 500 for comparison. And you can see in 2018, the rates went to as high as 3%, and the equity markets took a leg down here. And it came down here. And then from 2019 to early 2020, the markets went up as the rates went down. And then here we have what I'll refer to as an anomaly, an outlier. So rates went down and the markets also came down, and this coincides with the breakout of COVID-19, and there's nothing normal about that, which is why we have this anomaly on the chart. And at the moment, this is where we are, and even though the rates are beginning to creep up, they are still low by historical standards. And not only are they low, the Fed has indicated that they're going to accommodate low rates for some time. So if the rates get too high, I would expect the Fed would step in and supply liquidity into the market and push the rates back down. And low rates are good for equity. So again, this bodes well for anyone who is bullish and expects the the bulls to continue running the show. And finally, for the bullish case, I'll take into account the COVID-19 vaccine in the horizon and the implications that would have for the economy. So if we do have a COVID vaccine and it's widely adopted, then it's more likely to be an acceleration in economic activity, and that can only be good news for the market. So that's the bullish case. On the flip side, if I wanted to make a bearish case for why the markets cannot continue to go up, I will start with, believe it or not, with the same put call ratio that I used to make a bullish case, and here is why. So this is the same put call ratio chart that I showed earlier, and while it is true that the current reading is very low at 49, and that indicates a bullish sentiment, it is also the case that when the put call ratio is so low, it could mean that the markets are becoming complacent and it could easily snap back up because it is getting to extreme levels, and historically these extremely low levels tend to lead to a correction. Not necessarily a massive sell-off, but when we get to these extremes, the markets tend to bounce back. I tried to get an S&P 500 overlay on this chart, but I couldn't. But if I could, you would have seen the markets probably around here, had a correction, and we're getting close to it now. So that would be how one would use this put call ratio in a bearish context. The markets are getting to extremes, and when markets get to extremes, they snap and bounce back, they revert to the mean. So that is how I would make a bearish case using the put call ratio. I would also talk about the worsening job market. So a job market which is worsening is not consistent with an economy which is expanding. The non-farm payroll numbers came out today, and the street was expecting a print of around 440 additional jobs to be created for the month of November. Well, it turned out the reading came in at 245,000, which is significantly lower than the street was expecting. And one could argue that with the market going up, which suggests the economy is expanding, you'd expect jobs to be created to correlate with the market going up. But what we've seen is a contraction in the number of jobs created. So that could be, one could make a bearish case for that. I would also look at the VIX. One sec. So historically, the equity market rallies tend to be more sustainable when the VIX is below 20. And I know 2020 has been an abnormal year, but even then, the markets have been rallying. The put call ratio has been low, so there have been more calls being bought, or currently the put call ratio is low, and yet the VIX is stubbornly above 20. If you look at the relationship between the VIX and the S&P 500 in this chart, it goes back to 1980. You'll notice that the bull run that started in 2000 and the bull run that started in, let's say 91, from 91 here, 91 to 2000, before the dot-com bubble, the VIX was mainly below 20. This red line here denotes the 20 level. You can see it was mainly below 20, and then you had a spike around here, and then it went back to below 20 until the markets crashed and the VIX came high. Again, if you look at the bull run from, say, 2000 and let's call this 2002 to around 2008, before the crash, the VIX was mainly below 20. It didn't even go above 20 until the market peaked and crashed. And if you look at the bull run from, say, 2009, 2009, from around here, oops, not that, from around here going up, the VIX has generally been below 20. And then we come into this year, and here, the VIX has just been above 20, consistently above 20, and the markets are going higher. So a bear could make the case that with the VIX, I know the VIX has come down a little bit, but it's still above 20. You can make the case that the uptrend is not as sustainable as it would have been if the VIX had been below 20, and it's currently above 20. So that's another case for the sell side. And one thing I forgot to mention, the market is at an all-time high now, and the VIX is not retracted below 20. So the markets are pricing in some more volatility to come, and that doesn't bode well for anyone who expects this thing to keep on going indefinitely. Another thing I would look at to make a bearish case would be the current valuations baked into the market. So the S&P is currently trading at a PE multiple of 37, a price earnings multiple of 37. And that means the current S&P level is trading at 37 times 2021 earnings. Now, some would say that is pretty high, and that the valuations for stocks are currently very rich, and there might not be much room to the upside. And if you look at this chart, I tried to find an overlay of the S&P 500 price itself, but I couldn't. This is a chart of the price earning ratio of the S&P 500 going back to 1880 actually, and there are three major outliers that you can see. I just drew this line here arbitrarily, nothing scientific about this line, but you can see here, this was the dot-com bubble in 2000. Valuations were pretty high. This was 2008, the financial crisis, and this is where we are now. So the valuations of the S&P 500 stocks are not particularly cheap. Some would say they're fully valued. Some would say maybe there's more room to run. But if you're bearish, this is another thing you'd look at that would give you some more comfort to hold on to your short positions. And the final point I'd make for a bearish case is I'll look at the current stimulus package on the table. The current stimulus package does not include a check for $1,200 for every American like the first one did. And if that stimulus is meant to stimulate the economy and keep the rally going, well, consumers are not going to have as much money to spend as they did the first time around. And with markets at record high, one could argue that the path of least resistance is to the downside. So those are the two sides of the coin, if you like. You have the bullish case and you have the bearish case. And depending on where you are, how you're positioned, or how you want to position, you stick to either side. But luckily for me, and luckily for us at Vertical Spread, we do not need to pick a side. We don't need to be bullish or bearish. I simply need to look for high implied volatility underlies and construct some really good spreads that will make money, regardless of whether the market goes up, goes down, or goes sideways. So if you ever needed another reason to trade spreads as opposed to being bullish or bearish, that is it. We don't need to stick to one side. Just look for high implied volatility and put together some nice spreads and wait for theta decay. And that takes me on to my trade ideas. I had no new trade ideas today, but I did have one earlier in the week in MRNA. And I also closed out the last position I had open in the December contract. For more details on those trade ideas, you can visit the Trade Ideas forum, and I'll also drop the links to the two trades below. So for the December contract, I had 4 positions. All my positions hit their profit targets, and all positions are now closed. There are now 41 days until the January contract expires, and I do have a few stocks that I'm watching for trade ideas. I will send out trade ideas alerts as soon as I see a risk to reward ratio that I like. I haven't seen much yet apart from the MRNA one. But that said, there is still ample time for me to find trade ideas for the January contract. There are 41 days to go, so that gives me about 11 days to find some decent trade ideas. And I have been looking, and I'll keep looking. Onto my open positions. I've only got one open position, like I said, and that one is in MRNA. Opened on the 1st of December this week. I sold the 115-110 put spread for a credit of $2. Got a really good credit on this one. Let's see where MRNA closed today. Moderna. So MRNA closed at 152. I sold the 115-110 put spread. So my short 115 strike is conveniently out of the money at the moment, and no action is required on this one. I only just opened this position this week, so I'm not going to analyze the P&L today. Next week would be the end of week 1, and I'll analyze it then. And that takes me onto my watch list. So on my watch list for today, I have got MSTR, UNG, PDD, ARKK, and CRON. I'll have a look at them. I'll take them in turn one by one. MSTR has implied volatility of 73, and that's why that one hit my radar. It hasn't got that much liquidity, it's only 1 star, so I doubt I'm ever going to do anything on this thing, but just to let you know, it hit my radar because it's got high implied volatility. UNG is an ETF that tracks natural gas. It's got an implied volatility of 62. It's a low priced stock. I'm unlikely to do anything in this one. PDD, $146, implied volatility 59. I'd love to do something in this, and I've been looking at it. I'm just waiting to get the right risk reward ratio for the strikes I'm interested in, and this is one of the candidates I'm looking at for next week. ARKK is another one. Traded this one quite a bit over the last few months. 117, implied volatility 52. It's another one I'll be looking to do something in. It's got a decent, it's over $100, and implied volatility is high, so I'm just waiting for the right risk reward ratio on this one as well. And finally, the last one is CRON. This one is a low priced stock. It's only $8. Implied volatility is high. I'm unlikely to do anything in this one. The price is quite low, and I would have to sell a boatload of contracts to get a decent premium. Excuse me, and that means I'll probably end up paying an awful lot of commission as well. So that brings me to the end of my journal for today. The main highlight is that I got on board the January 21 contract with a trade idea this week, and I'm going to continue to look for more trade ideas for next week, so keep an eye out for a trade idea alert sometime next week. Thank you for listening. I hope you enjoyed listening to the journal. You can leave me any questions or comments below, and have a fantastic weekend. Thank you. Goodbye.